These companies weren't developed for profitable business models, but rather capital investment because capital was so easy to find. Rather than building revenues on their own, these companies acquired by either merging with or acquiring other companies or acquiring assets of other companies at overinflated values. Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today, we're going to take a look at the great cannabis crash of 2019 and ask ourselves, why did the industry stall for more than a year? And then maybe look at some failures in 2020 as this one CU predicts that the cannabis failure is going to be big this year. I would tend to agree. Bad news about the so-called green rush rolled out slowly at first, picking up steam around the end of last summer. Stocks started to dive, layoffs were announced, executives were just months earlier forecasting great riches, suddenly acknowledged, mostly in whispers, the deepening gloom. And since last August, the North American Marijuana Index, which tracks cannabis stocks, has fallen by half. The problem with pot stocks isn't limited to California, it's continental. Too many investors looking for a quick buck creates a bubble. As with internet stocks in 99 or housing in 2007, the bubble has now burst. That's only echoed even more loudly with MedMen's whispers about some of the founders having to take 50 cents on the dollar for the shares that they have, almost like a Ponzi, so they could take the shares and give it to new people to help them drive, just like High Times is trying to have brick and mortar so that they can, recreate themselves. Private companies had a whole bunch of layoffs that they announced too, including Pax Labs, Grupo, Florcana, Cannacraft. There's rumors even about Snoop Dogg's investment with Ease going under. Ease blew through $166 million somehow. So it's not like the entire cannabis industry is imploding, but part of it is. The industry as a whole is falling short of what the forecast told us, but those forecasts were made by legislation advocates and politicians intending on selling skeptics on legalization and a tax bonanza, which supposedly it would yield. Legalization proponents insisted that pot would put in $1 billion a year into the state coffers starting in year one. That number turned out to be just $288 million for the first fiscal year. For the second fiscal year, which we're still in, the estimated tax hike will be $359 million. Meanwhile, there are just about 800 dispensaries operating in the state, a far cry from the predicted 6,000. And California's launch was no different than any other regulated state, with a slow release in Canada to Illinois selling out. I mean, every regulated launch has had its issues. Nothing new there. So the article goes on to cite two major problems. One is that the effective tax rate is more than 40%. And second, and probably worse for the industry, is that local governments remain hesitant to allow legal operators to set up shop. You can see in Vancouver, BC, Canada, being the last one to open up the rec shops drastically reduces sales, impacting the entire industry. And if it's taxed too high, people aren't going to buy it. So you could go into a shop, look at the price, and walk out and know somebody that you could probably get it from for cheaper. So if it's not a trusted product, if it's not convenient, it's not at a price that's affordable, people will go elsewhere. Part of the problem is that too many cannabis boosters drank their own Kool-Aid, banking on rosy forecasts often produced by them or their industry friends. They ignored enormous startup costs, underappreciated the burden of complying with strict regulations, and in some cases issued stock to the public too soon, usually by listing on Canadian stock exchanges. I'd say at least 2/3 of the individuals that are in regulated states haven't taken advantage of analysts to look at the data that's available to figure out and optimize efficiency in products and overall operations, whether that's automating, figuring out the best zip codes, flavor profiles, whatever it is. This industry will see a huge amount of failure. And the reason we haven't already, because in normal businesses you would, a restaurateur would have closed, several years ago, whereas in Washington, after 6 years, people are holding on because they're altruistic. So an individual who has that medicinal love for the plant and knows and wants to help people, they'll stay in the game even if it means not paying themselves a salary. So once the money runs out, once the economy kind of corrects, once something happens, there'll be a huge amount of collapse, capitulation. For a lot of these companies that did go to the Canadian marketplace to file an IPO are finding that the cost of compliance is really, really high. And so when your stock price is trading at 37 cents and you're on the OTC in the US, that's neat. But if your stock price isn't high enough, then you're paying for all of that compliance. It's not really worth it. And most of these companies aren't set up for that anyways. They're already struggling as it is. Washington continues to slap hurdles and regulations every single year, from banning CBD gummies in 2017 to then trying to impact the edibles market, and then banning CBD beverages, and then trying to impact the concentrate markets to a 10% cap, whatever it is, putting a felony on marijuana lounges, impacting billboards or out-of-state investors. Well, Washington is the petri dish experiment as to why that collapse could occur due to overburdening regulations. And could also explain why there's been an industry stall for more than a year. Canada hasn't really been able to see the full impact because they were limited on their derivatives. They couldn't have concentrates or edibles or beverages. And so just seeing the flower, which is a decent seller initially, is one of the slower sales growths as new products take on. They'll obviously sell a lot more. Joints are the number one SKU, followed by concentrates being like the number one group or category. And again, part of that stall was because of the slow development in California, in Canada. Overall, though, in 2019, the sector dropped 32% against an increase of 29% for the S&P. So a 60% swing is quite extraordinary. And so during a year in which investors could throw a dart and make money, the cannabis sector lost around a third of its value. So the cannabis industry still represents a $100 billion opportunity in the US, $200 billion globally. But that kind of market opportunity only exists in a world in which the US has legalized cannabis at the federal level. Doesn't happen soon. This CEO predicts the cannabis failures in 2020. Why, you may ask? Well, first, the rollout of cannabis retail has been far too slow across Canada. These LPs have developed business models based on supply meeting demand, but in order for that to have worked, we've needed far more retail stores to open than we've seen, particularly in British Columbia and Ontario. As a result, these LPs are burdened with oversupply, causing them to miss revenue projections, which in turn has caused a massive sell-off due to underperformance, downward pressure. Second, these companies weren't developed for profitable business models, but rather capital investment, because capital was so easy to find. Rather than building revenues on their own, these companies acquired by either merging with or acquiring other companies or acquiring assets of other companies at overinflated values. Come financial times, they've needed to either write down or completely write off some of these acquisitions. As a result, their market caps are negatively affected because investors are viewing these assets as major liabilities. Considered a $50 million write-off from Constellation Brands. And finally, all this has created an unstable model that relies on continued capital raises, but that capital has all but dried up. What's still available is either very expensive or toxic, or both. What we're seeing across the industry are rickety financial models and convertible debentures that'll start to strain cash flow if they haven't already, which means these companies will have trouble becoming cash flow positive because they can't meet debt. These debts have to convert at some point, but because the markets have gone down, the conversion prices are way too high. Investors are simply going to want their money back, but it's likely that these companies will have trouble actually paying it back. Receivership is inevitable for some, but there's some hope for investors in this scenario. Cannabis stocks have been oversold, so quite a few of the good companies are undervalued. The truth is, the shift in the markets for cannabis companies was inevitable. It'll also be a net positive for the industry, particularly for the companies that have been built on a sustainable, profitable business model. The markets will sort itself out. The weak companies will either fail completely or be absorbed by the stronger ones, and we'll see more sustainable and innovative players survive and stake their claim. Self-explanatory. So with that, we're going to roll this one up. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out.